Thank you for joining us today, ladies and gentlemen. Let's crack on with our next episode in the Admiral Markets Trading Spotlights webinar series. Here today, we'll talk about how to use currency correlations in your own FX trading. My name's Paul Wallace, and I'm your guide for the Monday episodes of the Trading Spotlight sessions. So, as I said, hopefully you can all hear my voice, you can see me, you can see the screen. What are we going to talk about today? Well, not surprisingly, I'm going to talk about what are currency correlations and how and why those different currencies are correlated. Not surprisingly, we'll also look at about how to use currency correlations in your own trading. And, importantly, we'll look on to, I'm actually going to talk a little bit about how does that lead on to intermarket analysis, which I appreciate some of you may be aware of it, some of you may not be, and hopefully by the end of this session, we'll have helped with the sort of educating you on that. And not surprisingly, what benefits do they provide as traders in the markets? And as always, if there is time, we're always on a bit of a time pressure that if there is, then we will look to check them out on live market. So thank you all for joining us for this session. As I said, stay to the end and we'll go and look through them on live markets. If you're watching this on YouTube, then please, feel free to comment if there are questions along the way. Please just ping them in. There should be in a chat box, okay, or on the YouTube page. We're always delighted to get your interaction to hear how we can help you better. So please, please, we love the engagement and the interaction between us. So fire away. So for those of you who don't know me, my name's Paul Wallace. I've traded for many years after actually having a previous career as a battle manager. I've been very fortunate to, primarily for my own trading, I focus on FX indices and commodities. They're my kind of preferred playing fields. For my kind of longer term positions, then I'm actually trying to be a dominant trend trader using strength and weakness. But for intraday trading, I will like to focus on mean reversions. And if you join us for our session next Monday, that's where we're going to be talking a little bit about the intraday trading. As always, we're representing Admiral Markets here, and they are a Forex and CFD broker with over 8,000 financial instruments. So there's plenty there for you to trade and engage with markets. And of course, they have offices and support in over 20 countries. They are licensed by a multitude of regulatory bodies across the globe. And interestingly, that for very popular trading products like the Euro-Dollar and the DAX 30. They provide very competitive spreads there. And you can trade through the world's most popular trading platform, MetaTrader. Okay, we've got both MT4 and MT5 available in phone, desktop, and browser, and also with the Admiral Markets Supreme Edition plugin. If you have any questions about that, please get in touch with your account representative, and they'll be very happy to help answer your questions. So, ladies and gentlemen, what are currency correlations? Some of you who are completely new to trading may not even be aware of such a thing called currency correlations. I appreciate some of the people who join us in the room. We have a broad broad church of experience when it comes to trading. Some of you may well be aware of currency correlations and how they can help us. But not surprisingly, the sort of correlation is about the relationship between two instruments. And to begin with, in this case, we're looking about the relationship between two currencies. And it really is about, in particular, how they move in relation to each other. And what you can actually do is that, currency correlations, it's the statistical measure of whether two currency pairs move in the same, opposite, or totally random direction. And if you're going to be a professional trader, well, you'll need to understand these currency correlations. You'll find that some of them they change, but sometimes during the let's say during the trading year they can be very strong correlations. Other times they can be quite weak. But as we're showing a few examples here throughout our session, that it's important for you to know and understand them, so you're actually in a position to help them when it comes to actually making your own trading decisions. So if you to go into the data. You can compute it into what is known as a correlation coefficient, which ranges between -1 and +1. So if two currencies have a perfect positive correlation, so a correlation coefficient of +1, that implies that the two currency pairs will move in the same direction 100% of the time. And of course, the reverse of that is if they are positively negative correlation. So that means that the currency pair will move in the opposite direction 100% of the time. And if the correlation is 0, well, the movements between the two currency pairs is said to have 0 or no correlation. They are completely independent. Now, it'd be interesting to know that any of the people here joining us today, are you already aware of any particular currency correlations within your own trading experience? Have you seen particular movements in particular markets and sort of noticed patterns of particular currency correlation? If you have, then basically, then please just put it in the chat box. Okay, if you've already noticed, it kind of helps me to understand the sort of the kind of interesting ways that that traders will notice particular currency correlations. So Robert has just put there how he can see correlations between dollar, yen, and gold. That's interesting, Robert, and we'll have a look at that. That kind of probably moves more towards the sort of the intermarket analysis, but I'm very happy for us to have a little look at that later on in the session if we have the time to go through it. But thank you for sort of adding that to the conversation. So here is an indication of the euro against the US dollar and the sort of correlations that it has there. If you really wish to sort of really go into it, how to create them, if you wanted to create them yourselves, the actual currency correlations, you can Google how to calculate currency correlations with Excel. Some of you may find that very interesting, depending upon your the level of detail that you wish to go into. As a trader, I just want to be aware of the correlations. I want to see how I can utilize them in my own trading decision to either help confirm my decision or to make me aware if perhaps my trade isn't looking to work out, so I could leave early. So what we can see here is that we can see that this is the euro US dollar here. Let me just bring up our drawing tool here as always. What we can see here is the euro dollar and its correlations over particular time periods, 6 months to 1 year. So if we look at, let's say for 1 year, okay, that gives us a good bit of data. Well, what we can see here is that there is a 0.95, okay, 0.96, okay, a positive correlation there between the movements of the euro dollar and also the Aussie dollar and the Kiwi dollar. Okay, does anybody have a particular understanding of why that might actually be occurring? Why that currency correlation might be so strong? And on the flip side, what we have here is we have a negative and inverse correlation of minus 0.98 and minus 0.93 on the dollar CAD and the dollar Swiss franc. So we can see in those particular cases, the dollar Swiss franc and the dollar CAD, there's a very strong negative correlation, an inverse correlation, whereas for the Aussie dollar and the Kiwi dollar, there's a very strong positive correlation between the moves of them. So those of you who are, experienced traders and might be able to work out will realize that a lot of that is to do with because the dollar makes up the major part of those particular currency pairs. You've got euro US dollar, dollar against Swiss franc, dollar against CAD, Aussie dollar, and Kiwi against the dollar. And that gives us an indication of, where that correlation is particularly strong. But, interestingly, even you can see here on the, on one example, the Aussie dollar over the week, there's actually been very strong correlation and over the month, but actually over a 3-month and a 6-month period, whilst there was positive correlation, it was not as strong. So it's, these things can happen. These correlations, they will change, they will strengthen and weaken. But, you're just trying to understand the, let's say, the underlying theme. That's what we're particularly looking at. And not surprisingly there, in this particular example, we can see that, the euro dollar on the 1 week and the 1 month, it also has a pretty strong correlation there with the euro against the yen, 0.93 and 0.91. That's kind of of interest to us, all right? And over the week, we can see, well, actually, we also had quite a lot of correlation there with the pound against the dollar. So, we can see here that, of course, anything that has the dollar pair in it, not surprisingly, there is a strong correlation. That's, that's something that we can work on and we can utilize in our own trading decision matrices. But we can also see dollar against the Swiss franc here, okay? Dollar against the Swiss franc is inverse correlated, as is the dollar against the Canadian dollar. So hopefully you can see that you can see that the sort of effects of correlations and where they're particularly strong or particularly weak. We can actually sort of interestingly sort of you're looking at something like euro sterling, all right, euro sterling over the entire year. Well, there's actually sort of, very little, almost kind of like zero correlation over a year. But over the last couple of weeks and months, there's actually been a pretty strong correlation. So as I say, they change, they adapt. As markets change, so do they. They strengthen and they weaken, and it's about you just being able to understand the kind of underlying major themes as a trader. And I'll show you when we go across to the live charts how we can utilize that to help us with looking for trade decisions. So, here's an example here, okay? Remember that we talked about, let's just get the drawing. We talked about how the euro against the US dollar and the dollar against Swiss franc, there was an inverse correlation, a negative correlation. And so hopefully you can see here that, we had a little bit of chop here on the euro dollar. This is the 4-hour chart, the euro dollar, okay? Before we actually saw price move in a nice zigzag down, okay? And that's been a really particularly strong drop. Whereas, on the dollar against the Swiss franc, well, we had a little bit of quite a little bit of chop before we've sort of risen. Okay, price risen, it came back and has continued to rise. So hopefully, there you can see the sort of the strength of that inverse correlation as the euro against the dollar has dropped, the dollar against the Swiss franc has risen. So what are we able to sort of take from that? Well, just looking at those two charts, we can see that invariably that there's a great deal of strength in the US dollar at the moment. Looking at that, that's what we can take from that, because when euro dollar is going down, that's showing that euro is weakening and dollar is strengthening. And when dollar against the Swiss franc is rising, that's showing us that dollar is strengthening and the Swiss franc is weakening. So these correlations, you can see them on the charts, okay? When they're very clear, it helps enormously. I'll tell you a little sort of kind of segue from my own trading experience from using correlations, and in particular in these particular charts. So many years ago, okay, you could look at euro dollar against the dollar Swiss franc, and as an intraday trader, what would happen is that we would see I'd be watching the euro dollar and the dollar Swiss franc on the sort of 5, 10, 15-minute charts. And at that time, around about that time, the euro dollar had an average daily range of around about 70 pips a day. And the dollar Swiss franc had effectively had a move of around about, the average range was around about 120 points, okay? So nearly double, okay? It's about 1.8, all right, in terms of the how far it moved instead of the euro dollar. So quite often I'd be able to use those correlations to help me choose a particular better trade opportunity. So if I had the same setup appearing on both the euro dollar, okay, let's say I was going long euro dollar and short dollar against Swiss franc, maybe there was a rejection candle that I was looking to trade. What I could do is I'd be able to sort of take the trade on the dollar Swiss franc, because I knew that because the average range was greater, the likelihood of me having a greater run in terms of being able to sort of have a better profit target for my particular trade, that would help me. Okay, so that's how I would utilize correlations in my own early trading to sort of try and help me harvest from the markets better. But for the moment, for yourselves, I just want you to be able to see and recognize when you see these either positive correlations, or in this particular example, the sort of negative correlations, inverse correlations occurring there. And, here's another example of it, okay? Here's another clear example. What we have here is, what we've got here is the weekly chart, okay? And this is the euro against the sterling versus the sterling against the Swiss franc. So what we can see here on the weekly chart, is quite interesting. We had sort of a weekly key reversal, price dropped down, then it put into a double bottom pattern before launching itself up there, okay, up to past the 90 level before it came straight back down. If we look at the pound against the Swiss franc, okay, pound against Swiss franc, all right, started with a strong leg up where it formed actually an M pattern, a double top, before actually collapsing all the way down and then sort of having a slowly reverse, which is where we are at the moment. So hopefully, as traders, you can see that once again, the euro sterling and the sterling Swiss franc charts, they are inversely correlated, okay? As one is rising, the other is dropping. Why is that? Well, that's because we're trading the sterling pair here, okay? In the first example on the left, you're trading the euro against the sterling. The second one, we're trading sterling against the Swiss franc. Euro and the Swiss franc, okay, there is a correlation between them. We've just seen that on euro dollar and dollar Swiss franc. Not as strongly correlated as it might have been a couple of years ago, but it's still there. And hopefully you can see that very clearly in a very visual manner how those charts interact. So once again, if you're in a particular position, let's say if you have a position that you're long euro sterling, well then if you're also seeing the sterling against the Swiss franc dropping nicely as well, that just gives you confidence and confirmation in your trade decision. That's what we're looking to see, and that's how we can utilize to help ourselves with our own particular trading ideas. So hopefully there you can see now how currency correlations occur and actually how they operate and how they set up and how you can visually see them, whether they be positively or negatively correlated in those particular cases. But not only do we see correlations in currencies, but we also see such correlations with currencies and different asset classes. And this is very often called intermarket analysis. So I think it was Richard who was before earlier sort of saying that he could see correlations between the dollar, Japanese yen, and gold. Well, that would become more of what we would term intermarket analysis. Now, for those of you who are old enough to remember the GFC of 2008. Well, that in many cases that kind of destroyed and changed the intermarket analysis for several years, either because there was a breakdown in the particular way those markets were traded, or you had elements of QE come in, which were basically distorting markets in terms of the way they were correlated. But what you'll see is that now we've started to return to some of those kind of standard trends within intermarket analysis. And what we'll do is we'll go through and have a chat about them and see if they can see if you can recognize and see them operating in your own trades. So here's the first one we're going to look at. Once again, let me just get our drawing tool up. So this is the weekly. This is U.S. oil versus the U.S. dollar, Canadian dollar. Okay, so I should have the charts. The charts are a little bit flipped, but it's the right charts there. We have here the dollar against the Canadian dollar. We can see that has actually been very, very strong move uptrend. Okay, followed by a strong move down. Whereas here on the oil, what we've seen is oil prices has dropped. Okay, and then we've actually seen the oil prices strengthen there towards the end. Would anybody here in the room know why that might have occurred? Would they understand what's actually happening there and how that becomes important to us to understand as traders? So Robert says that oil is important to the Canadian economy. And you're absolutely right, Robert. You're absolutely right, okay? So what we have is, oil is, Canada is still one of the biggest exporters of oil. So, of course, when the oil price is rising, that's really good for the Canadian dollar. Or alternatively, when the oil price is dropping, that is not very good for the Canadian dollar. So what we've actually seen is that let's say, very recent experiences that, over the summer, okay, what we've seen over the summer is we saw the Canadian dollar strengthen. A lot of that was off the back. We had, of course, tensions in the Persian Gulf. We had tensions with Iran, okay, over some of the shenanigans going on there in the Persian Gulf. And not unsurprisingly, that makes people nervous, okay, that made people think that the price of oil was going to rise in case there was a conflict there. So, of course, as the price of oil rose, so did the strength of the Canadian dollar. And so we saw Canadian dollar strength over the summer period. Okay, so they start to understand how you can actually utilize these kind of correlations in your own analysis to sort of understand the impact of one event happening in the world, what that might have in terms of your actual currency correlation. So as I said, not unsurprisingly there, in this particular case, what we can see here is the oil price has been dropping. You can see that quite clearly there, can't you? Not surprising, as the oil price has been dropping, the dollar Canadian has been going up in price, okay? Remember, the US up until a couple of years ago used to import a good deal of its oil. It's now self-sufficient. So actually oil price moves would be very, very, very sensitive to, US dollar would be very sensitive to moves in the oil price. But even still, there's still that sort of intermarket analysis, the correlation of, the oil price dropping or the oil price rising has an impact on the Canadian dollar. So if you're seeing the Canadian dollar and not sure to understand why it might be very strong, or why it might be very weak at that time, take a look at the price of oil, okay, US or the West Texas. That might give you a little bit of help in understanding where it happens. So Vincenzo says there are also correlations between ruble and oil, right? Yes, there are, but in my experience, I haven't seen them as strong as they are with US oil and Canadian dollar. But yes, it's definitely the ruble is sensitive to moves in both oil and gas because of Russia's position as a major oil and gas exporter. So here we go on to another hard commodity, and what we've got here is, it's a bit of a little bit of a kind of an interesting one in that we're looking here at correlation there, or intermarket analysis between the sort of the dollar, Canadian dollar, versus gold. Okay, and this is kind of an interesting one for us to look at in this particular moment. Because we just talked about how that how that oil is Canada is a big exporter of oil. It's also a great big exporter of Canadian dollar. It's also a great big exporter of gold as well. Of course, Canada is an exporter of Canadian dollar, but it's also a big exporter of gold. And it's kind of interesting to look at it at this moment, because normally we see quite a strong correlation there between weekly the Canadian dollar and gold. And what we saw was, we can see here, this is from the recent move here, we can see gold has been on a bit of a tear, okay, since the early summer, okay, and I hope some of you are able to sort of take position on that, and if you did, well done to you, congratulations. It's a really nice, strong move, and what we saw at about the same time was that we saw a drop initially. We saw a drop in the dollar against the Canadian dollar. Okay, remember, if that price is moving down, that's an indication that the dollar is weakening and the Canadian dollar is strengthening. But hopefully, what you can see is actually over the last couple of weeks is that we've actually had a little bit of a move there. Okay, a little bit of dollar strength come back into the market, a bit of Canadian dollar weakness, and it'll be interesting to see, will that sort of pay out into gold? Will we actually see gold either sort of go sideways or maybe move a little bit of a slip to the downside? Just keep an eye on that, okay? Because the thing about gold is, it's very much linked to the geopolitical. The lights go off in my office there. The lights are time. They're all based on sensors. But actually, what we can see is that gold is sensitive to the geopolitical situation. We've had plenty going on this year that have to worry traders on a geopolitical basis, whether that be Brexit, whether that be the US-China, Trump trade talks, and also we've had, as I said, a bit of a tension in the Middle East with Iran there. So there's always been something there sort of causing a little bit of causing a little bit of mischief in the markets, and it's about how can we utilize that for our own conversation or our own trading decisions. And you can see there, it's as I said, gold, when gold initially rose, we saw a Canadian dollar strength, but actually it sort of started to come off a little bit. We've had a bit of dollar strength there over the last couple of weeks. Okay, so now admittedly part of that could be due to is maybe the tensions with Iran have sort of simmered down a bit, and that can have a knock-on impact. But as I said, just keep an eye on gold. I'll be adding gold to my watch list to see, will there be a bit of profit taking? Will there be a little bit of a move sideways or to the downside? Okay, over the next couple of weeks as part of that correlation, and whether it's actually leading gold at the moment. So add that to your watch list. So here's another correlation here that we can talk about. So what we're looking at here is this is the monthly Nikkei, okay, versus the Japanese yen. Okay, we've got and what we have is here is an inverse correlation. So what we can see here is over the last few years in the monthly chart, we've seen that the Japanese Nikkei, okay, which on the Admiral Markets MT4 platform is JP225. Okay, we can see that has been in overall quite a strong uptrend. And at the same time, what we actually saw here was effectively this was a big strong move up here in the dollar against the Japanese yen. So let's think about the correlation and what kind of movement we've seen. So what this is implying is that as the dollar is strengthened and the Japanese yen is weakened, that has been good for the Nikkei, the actual main Japanese stock market. Well, what's the understanding behind that? What's the reasoning behind that? Well, Japan is an exporting economy, right? Japan has, it's driven by its export, the sort of strength of its overall economy. It's based on all of those big Japanese companies being supremely efficient at exporting their products. So what will happen there is, the weaker the Japanese yen becomes, the more attractive their exports become, which means the more attractive their those Japanese companies on the Nikkei stock market become to investors. So, and that's why we see in the Bank of Japan, they're always very, very keen to stop the Japanese yen from strengthening too much, because they know a weak Japanese yen will help their stock market, help their Japanese companies. So it's not really a surprise to see that, as the dollar yen has risen, which is showing dollar strength and Japanese yen weakness, well, we also got a great run there on the Japanese Nikkei stock market as well. But nothing ever lasts forever, and what we'll see, I suspect, is we will see some moves of that. That looks like on the Nikkei, that looks like a sort of almost like a double top formation there. Okay, and what we'll see is we will see an element of whether that has a knock-on impact. Because those of us who follow the markets, we notice that Japanese yen has been quite strong over the summer. So that will always have when that Japanese yen strengthens, that has almost like it weighs on the Nikkei. So that becomes a key point to sort of bear in mind if you're a trader of Japanese yen and the Nikkei. And here's another example of the intermarket analysis. So what we're looking at here is this is the weekly Dow. This is the weekly Dow versus the Japanese Nikkei again, and there's a positive correlation. Okay, they don't move exactly the same, but there is a positive correlation in the sense that as the Dow has overall sort of strengthened its way up, so do we see that in the Nikkei as well. Okay, and now admittedly, there's kind of a few elements at play here. One of the simple ways is it's almost as if we are moving towards one big global index. If you look at a lot of the major global indices in the world, they tend to track the American indexes. Okay, for the most part, there's a correlation there in a sense, but what we see is, the big major global index. So you're looking at, the Nikkei, you're looking at the Dow, the DAX in Germany, you're looking at the FTSE in the UK, the CAC in France, okay, IBEX in Spain, the MIB in Italy, etc. you'll find that they very often track what the American indexes are doing. And so this is just an example of it, okay, is that weekly Dow chart has been grinding its way north. It's not so surprised to see that basically the Nikkei has been grinding north as well. There is a positive correlation to that. So it's something that we can when we see that when we see correlations in let's say in a strong element, we can look across the American indexes and we can look across the sort of rest of the global indexes. When they're all moving together nicely in an uptrend, well then that gives us that gives us the sense of the warm and fuzzy feelings about how happy we are in our long positions in indexes. But if you see breakdowns in the correlations, that starts to get me a little bit nervous. It starts to get me a little bit worried about what might be happening and what kind of changes are afoot. And here's another interesting correlation for you, okay, is that what we have here is, in this particular example, this is the daily US oil, okay, once again, it's West Texas versus the CAD Japanese yen, and there's a real positive correlation beneath that. So hopefully I'll try and explain why that should be. Well, we know that West Texas, it sets the benchmark there in Brent in terms of the price of oil around the world. But you have to look at the Canadian dollar and the Japanese yen. So remember what we were saying earlier on a few slides back, how the Canadian dollar, okay, Canada is a exporter of oil. So invariably the price of oil will have an impact on the Canadian dollar. Equally, though, the price of oil will also have an effect on the Japanese yen. And why is that? Well, Japan imports the vast majority of its oil. I think it might be somewhere between 96 to 98% of all of its oil it has to import. So, of course, that Japanese economy is very sensitive to the price of oil. If the price of oil is very, very strong, or is very high, that will have a drag effect upon the sort of Japanese stock market and therefore the sort of Japanese yen. It also has, it has the oil price has, of course, as we said, has a really good, strong correlation with the Canadian dollar based on Canada being that exporter. So actually what we can see here is that, it's not a perfect correlation, but, there is definitely a correlation here, okay? The 12th of December, here we go, January 2018, after the crash, we did a flash crash. We actually moved in the same way. And since then, we've kind of ground our way down. It might be, some people might say we're in a bit of a descending triangle, okay, and whereas opposed to we're in a bit of a descending channel there on the CAD yen. But so, there is a positive correlation there. And interestingly, I'll, sort of as an aside, I know a gentleman who, who trades, he calls himself an oil trader, but actually primarily all he trades is the CAD yen. CAD yen is quite often used as a proxy for oil in the FX markets. So I know one chap who's a fund manager and he literally just trades CAD yen. He calls himself an oil trader, but he doesn't actually trade oil. He trades the CAD yen, okay, and that's his particular sort of a specific niche that he works upon. So once again, if you're watching the price of oil and you're seeing moves there, well then it's always worth having a look at what the price of the CAD yen is doing as well, and is there a really strong positive correlation there between the price of oil and the price action in the CAD yen. So, and here's one that might be a bit close to home for those of any of the sort of UK listeners, as of course, as we've got here, monthly pound against the US dollar versus the FTSE 100, the UK index. And what we're looking at here is a little bit of an inverse correlation here. So what we can see here on the monthly chart is, we can actually see for the most part, we have been in a pretty significant downtrend there, okay, in the pound against the US dollar, okay. Hopefully you can all see that there. But, from that same time, what we've also seen is effectively for the most part, a strong move up in the FTSE. So, once again, what has actually been occurring here? What's happened? Well, there's a little bit of a twist to this, is that what we find is that the FTSE 100 these days is not necessarily a true and accurate reflection of the UK economy. And that's because of the nature of the makeup of the companies that make up the FTSE 100. The vast majority of them are now what you might term as global multinational companies. So invariably what happens is, as global multinational companies, most of their profits are now made overseas rather than in the UK. So what that has an impact on is that when the sterling is strong, that has a drag effect upon many of the companies in the FTSE 100, because if the sterling is strong, that means the profits that they're reporting overseas in their global operations, which could be in dollars, could be in euros, could be yen, Canadian dollars, etc., that will have an impact on the profitability of those companies, and therefore that will have an impact upon how attractive they are to investors and whether investors are looking to buy or sell them. And alternatively, when sterling is weak, and of course, you know, since the Brexit vote, okay, sterling has been pretty weak. Well, that is why we have seen that even though Brexit, you know, some of the sort of issues with Brexit, some of the hammering that sterling has taken has actually had a good impact upon those FTSE 100 companies, because if sterling is weak, that means that the profits that those global companies are picking up to sort of collecting their profits in other currencies, that means those profits are now suddenly looking much stronger when they are compared to a very, very weak pound. And here's another example, okay? This is the euro-dollar, the 4-hour chart against the German DAX, okay? So euro-dollar versus DAX, 4-hour charts. We've got an inverse correlation. What can we see here? Okay, here's effectively the DAX is, euro-dollar is on a free fall, and the DAX is actually moving nicely. And there's a little element of the sort of same truth that we've seen in both the FTSE and the sort of Japan situation. But, you know, part of it was also been exacerbated by, you know, over the last few years in terms of what we saw with quantitative easing. Okay, in fact, as the printing presses were rolled out, what we saw was that invariably you know, that had an impact upon, you know, a nation or a sector's major currency and their major stock market. So in this particular case, for what happened for a couple of years was that as the printing presses were run as part of European quantitative easing, what we saw there was that the euro was weakened by quantitative easing, but actually the DAX, okay, the German stock market, actually benefited massively from it. So what you would see is that money would be created, be printed, it would be handed to sort of, you know, European banks, and those European banks would then use that money to buy shares in the German stock market. So that is why we would see an element of that, and there's still a kind of a follow through from that. But namely, you know, when we see the euro is weakening once again, the DAX 30, Germany is a exporting economy, so invariably it's looking to, you know, sell its goods overseas very aggressively, and so invariably that means that they have, you know, those companies have currency exposure, and so the weaker the euro is, the more profitable those companies on the DAX 30 look. So hopefully you've just been able to see then quite a simple visual about how those currency correlations into market analysis work. You know, but it's actually important as traders, what do they mean to us? How can we use them? Well, one of them says we can eliminate counterproductive trading. Okay, you know, there's no point taking lots of different positions on the dollar if they're all correlated and they're all moving in the same direction. What it does also mean is that you can kind of try and leverage profits, possibly. So that's what I was saying earlier, you know, years ago when the difference in the ATRs between both the euro dollar and dollar Swiss, you know, there was a bigger move on the dollar Swiss, so I would actually look to trade the dollar Swiss rather than the euro dollar. If you're understanding of the correlations and understanding of the average ranges, well, then that information can help you make good decisions about where you should place your trades. It allows you to diversify your risk, okay, and it also allows you to hedge your risk, and that's, you know, that becomes more important to you as you grow in a trader and your positions become more complex. But what it's actually also very, very useful for is also to help you confirm breakouts and avoid fakeouts. If you're a trader who particularly likes to trade breakouts as their main way of engaging with markets, well, if you're going to see a breakout happen across all of those euro pairs, for example, well, then that starts to give you a useful guide. Okay, that invariably there's going to be a strong move, and we actually saw one of those on sterling this morning, and we've got a couple of minutes left, and I'll just try and show you that for the last couple of minutes to give you a little bit of insight. So, as I said, currency correlations can be strong or weak, for days, weeks, months, or even years, but they do change, and sometimes they can change when you least expect it or when there is a major event happening in the market. They change for many different reasons, and those changes can include anything from maybe changes in interest rates. They always have an impact on FX markets, or if there's a change in monetary policies or any kind of collection of economic or political events, and they all help to reshape traders' sentiment, and of course that will have an impact upon either the strength or the weakness of particular currency correlations. So, as always, ladies and gentlemen, don't forget to join us next time. Okay, what we have here is on Wednesday of this week, which I think is the 11th, you can join my colleague Marcus to learn about diversification, including why is diversification important, what role does diversification play in our trading strategies, and the danger of not having a diversified portfolio or strategy. That's at 2 o'clock London time this Wednesday, September 11th. You can check your inbox for the webinar link, or you can head over to YouTube and watch it there, okay, on the YouTube channel. So, as always, you can find loads of analysis and education on the admiralmarkets.com website. Please feel free to sort of go and check that out. And as always, I hope you found that session useful. I hope it gives you some insight into the sort of different ways that currency correlations and intermarket analysis play out in the market. And as always, if you have any particular questions, you can contact us on hello@admiralmarkets.com, or you can check this session out or other previous webinars on the youtube.com/admiralmarkets or facebook.com/Admiral Markets Global. And if you do, feel free, make sure that you subscribe to the session so you're alerted of the webinar recordings, and also you have the opportunity to join. And please feel free to sort of leave a comment, to ask your questions. We're always very happy to engage with you. So, as I said, I hope you found that very useful. Give you a little bit of insight into currency correlations and intermarket analysis. We've got a minute or two left, so if you'll bear with me, I'll just show you a quick way of seeing breakouts and fakeouts and how currency correlations can help you with that. And we'll just do that for a moment or two. So, if you just bear with me a moment, I'll just try and quickly switch across. So here we go, ladies and gentlemen. I'm hoping that you can still all hear me and see my see the video, my charts, okay, and what we've got here. I'm just going to move some elements around here so we can see. So what I've got here, okay, this is the Admiral Market MT4 Supreme Edition here. And what you're looking at here is I have a profile set up with British Pound, okay. If you look at any of the previous webinars that we've done for Admiral Markets, whether they be through the trading spotlight or they've mastered the 4Ms trading, we talked about how we can set these up for particular currencies. I just wanted to show you a little element today, okay, in terms of kind of how correlations, and sometimes that can help you with avoiding fakeouts and breakouts. This was the pound against the pound against the major currency. So I have here pound against the dollar, euro against sterling, pound against Canadian dollar. Okay, there we go. Pound against the Aussie dollar, pound against the yen. Pound against the Kiwi dollar. I do apologize. Pound against the Swiss franc, and the pound against the Japanese yen. This morning we had GDP news in the UK. The news was much better than expected. And hopefully you can see on my charts here where I've drawn in those little red arrows where actually that sort of price was, the news was much better than expected. And actually what we had was we had a great rally in sterling. And we can see that basically at the same time, the same areas we had, basically pin bar rejection candles being printed. Here, let's just zoom in here a little bit on this one here for just trying to move everything around. What we saw was, you can see there yourself, hopefully there, okay, where the red arrows are showing that we had, either pin bars or in this particular case, engulfing candles or key reversal candles. And that was the sign there. There was a complete sign of that was a bit of a fake out that happened there in news, and price just pressed the other way. Price was very strong for sterling. And so if you're able to trade that this morning, then congratulations. There was a few nice trades there for us. But interestingly, just to sort of look at here, here's the euro against the sterling on the 1 hour chart. And underneath it, I have the pound against the Swiss franc on the 1 hour chart. And hopefully you can see that how absolutely, how strong the inverse correlation is, okay? How strong the negative correlation is between pound Swiss franc and the euro sterling. Euro sterling went up to the 90 level, big round number, and dropped away. Okay, pound against Swiss franc went down to around about 121 before it reversed and shot up there. Okay, and hopefully you can see there's strong correlations there in that particular case, an inverse correlation. But you can also see when you see a move happen across all of those sterling pairs. In this particular case, it was a fake out, okay, a false breakout before it reversed and went the other way. That gives you a fantastic way of being able to utilize this information to help you with your trading decisions. So there you go, ladies and gentlemen. As always, we're always a bit short on time, always plenty to talk about. As I said, I hope you found that useful. I wish you the best of success in your own trading, ladies and gentlemen. And I look forward to seeing you next Monday. Trade well, and I'll speak to you soon.